We're examining the state of the American economy, especially focusing on credit card debt. The data is pretty worrying.
U.S. credit card defaults have hit levels we haven't seen since after the 2008 financial crisis.
Really, it's that bad?
It is. In the first 9 months of 2024, lenders had to write off a crazy $46 billion in loan balances that were seriously delinquent.
Wow, $46 billion.
And that's a 50% jump compared to the same time last year.
So the last time we saw defaults this high was
14 years ago.
It sounds like the financial health of a lot of Americans is getting worse.
Unfortunately, that seems to be the case, especially for lower-income consumers.
Why are they being hit the hardest?
Years of high inflation have been chipping away at their purchasing power, and the savings a lot of people built up during the pandemic, those are pretty much gone now.
So they don't have anything to fall back on when things get tough.
Exactly. The bottom third of U.S. consumers have a zero savings rate. They're living paycheck to paycheck, no safety net for unexpected expenses.
Which forces them to rely on credit cards to make ends meet.
That's right, and that's a big part of why total U.S. credit card debt has exploded to over $1 trillion.
$1 trillion. How much of that increase is recent?
We saw a $270 billion jump just in 2022 and 2023. That's a mountain of debt, and with interest rates going up, it's a huge burden.
So how much are people paying in interest just to keep up with this debt?
In the year leading up to September 2024, Americans who couldn't pay off their balances in full paid a mind-blowing $170 billion in interest.
$170 billion. That's incredible. What does this mean for the U.S. economy as a whole?
Well, consumer spending is about 69% of our GDP.
So it's a major driver.
It is. If people have to cut back on spending because they're drowning in debt, it could have a domino effect. Businesses lose revenue, jobs are lost, and spending drops even further.
It seems like the Fed raising interest rates to fight inflation might actually be making things harder for people.
The Fed's decision to keep borrowing costs high has definitely added to the problem. Higher interest rates mean bigger monthly payments.
Yeah, less money for everything else.
Exactly. It makes it harder for people to pay for necessities or save money.
So is there any relief in sight? Will interest rates go down?
Well, there was hope that the Fed would aggressively cut rates in 2025. Early predictions were for a full percentage point reduction, but the Fed now says they'll likely only cut rates by half a percentage point.
So not much help for people struggling with credit card debt.
It doesn't look like it. And to make things even more complicated, the incoming president's policies are adding to the uncertainty.
How so?
Some of the policies, like tariffs and stricter immigration controls, are expected to push prices up even more.
Which means more inflation.
Potentially. And if inflation stays high, the Fed won't be able to lower interest rates as much. It's a tough situation for consumers already burdened with debt.
The delinquency rate for credit card balances is a sign of things to come, right?
Yeah.
It tells us how many people might end up defaulting. And that rate peaked in July 2024.
It did. And while it's gone down a bit since then, it's still almost a full percentage point higher than it was before the pandemic.
So this problem isn't going away anytime soon.
Unfortunately, that seems to be the case. We're likely to see more and more people struggling to make their credit card payments, and that has big implications for individual financial well-being and for the economy as a whole. We need to keep a close eye on this. It's interesting how decisions people make when the economy is good can come back to bite them later. During the pandemic, it was a weird situation. People came out of lockdowns with savings and a real urge to spend.
And credit card companies were ready to pounce, weren't they?
Absolutely. They were offering credit to folks who wouldn't normally qualify.
Which fueled the increase in credit card debt we're seeing now.
Exactly.
And then you had all that spending happening at the same time as supply chains were messed up from the pandemic.
Right, which helped drive inflation way up, and that forced the Fed's hand.
They had to raise interest rates
to try and cool things down, but that made credit card interest rates jump too.
Making things even tougher for people who already couldn't pay off their balances every month.
Those higher interest payments basically ate away at the extra savings people had from the pandemic.
Especially for lower income folks.
They had less of a cushion to absorb those costs.
And it's not like wages have kept up with inflation for most people.
No, they haven't. That gap between income and the cost of living has made a lot of households vulnerable. They're one unexpected expense away from real trouble.
We keep coming back to this, but the bottom third of U.S. consumers are in a really rough spot.
They're out of savings and relying on credit for basic necessities.
And with interest rates staying high and the cost of living still climbing,
more people are going to fall behind on their payments. It's a vicious cycle.
The delinquency rate peaked in July. That was a big warning sign.
It was. And even though it's dropped a little, it's still way higher than before the pandemic.
This is going to be a problem for a while, isn't it? it?
It looks that way. And then you have the incoming president's policies.
Which could make things even worse for consumers,
Things like tariffs and stricter immigration policies could lead to price increases.
adding fuel to the inflation fire.
And if inflation stays high, the Fed can't lower interest rates, which would give people some relief. It's a difficult situation all around.
So consumers are caught between a rock and a hard place.
It seems that way. Their finances are being squeezed from all sides, and that's not good for them or for the economy as a whole.
Consumer spending drives so much of our economy.
If people cut back because they're in debt, it could really hurt businesses and lead to job losses. It's something we need to watch very closely.
We've talked a lot about the negative side of things. What about the total amount of credit card debt out there?
Well, since the pandemic, it's gone up dramatically. Americans now owe over $1 trillion on their credit cards.
That's an incredible number.
It is. And the Fed raising interest rates has made that debt even more expensive.
How much are people paying in interest?
In the 12 months leading up to September 2024, people who couldn't pay off their credit cards every month paid $170 billion in interest. That's a lot of money coming out of people's pockets.
And how much credit card debt does the average household have?
Around $10,757.
Which is a significant burden for many families.
It can easily trap people in a cycle of debt. They end up using their cards for basic needs, which just digs them deeper. It's a tough situation.
And if enough people cut back on spending because of their debt,
It could trigger a recession. We know consumer spending is a huge part of the U.S. economy. A drop in spending could hurt businesses, lead to job losses, and slow down economic growth. And we're already in a fragile spot.
with inflation still high.
Yes. And the Fed can't lower interest rates easily because of that. Plus, the incoming president's policies like tariffs and stricter immigration could actually push prices even higher. It's all connected.
It's a pretty bleak picture, isn't it?
Yeah.
All this data about how much debt people have and how it's affecting them.
It's definitely worrying. The rise in credit card defaults is like a flashing red light. It tells us there are deeper problems in the economy that are hurting a lot of people.
And we've talked about how it all connects, right? People's finances, the government, the whole economy.
It's all intertwined. If people aren't doing well financially, it affects everyone. And that's why understanding these trends is so important.
So we can try to find solutions.
Exactly. Whether as individuals making smart financial decisions or policymakers coming up with ways to support people and the economy.
I guess the big takeaway here is that this isn't just about numbers on a spreadsheet.
It's about real people's lives. People who are struggling to pay their bills, put food on the table, keep a roof over their heads.
We can't ignore that.
We can't. We need to pay attention to these trends and work towards creating a more stable and fair economic system for everyone. Until next time, goodbye.